Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next, let's say, 30 minutes today. We're going to push it a little bit. We're going to go a little bit longer than we normally will do on Options Guide TV. Big week ahead of us. We're heading into the inauguration on the 20th. And that, I think, there's going to be some ramifications behind it. There's just been so much speculation on what the new policies will be. And there was a lot of euphoria behind it to start with. Now, a lot of people are the marketplace is starting to feel like this is going to get real. The 10-year and the yields on the bonds, and a lot of people like to use the term bond vigilantes. I don't quite know why, but they're driving up interest rates, and that is the one scary thing in the marketplace. The fact that the markets are saying that the Fed might actually, there's some indications they might be raising interest rates as opposed to cutting interest rates. Now, the futures marketplace is not showing that, but it's also not showing that there's going to be any cuts anytime soon as far as the Fed is concerned. So, been talk of the 10-year and the 30-year pushing up against the 5% level, which is recessionary in general. And that we're not necessarily saying that we're going to go into that into that economic stature, if you will. But obviously, the bond market thinks that interest rates should be higher, and that is what's happening in the marketplace. And the VIX is reflecting a lot of this, and a lot of that is because we're starting to sell off a little bit. So this week's a very important week, I think, in the markets. And we put a trade together on Friday that kind of went along with that scenario, because higher interest rates are a little scary for the small cap index. So we looked at a trade in the Russell 2000 index using the IWM, and we did a long straddle, and the marketplace in IWM, based just off of from Friday on, has now leaned a little more bearish. We did a more neutral, more volatile strategy in IWM, and the marketplace came off a little bit. And we're seeing as far as the chart is concerned, we're seeing the IWM bump up against the 200-day moving average. Now, I do think that this is a level that is fairly important in IWM, and if we do break through it to the downside, that would be good for our trade, not necessarily good for the market or the economy in general. You like to see small caps leading the way as opposed to being a laggard in the marketplace. But the small caps tell you a lot, but they are very interest rate sensitive, which makes a lot of sense because they usually have to borrow money in order for them to excel and grow. Okay, so we'll go and look at the chart. First of all, let's run then to the Tradier Pro software, and let's look at the chart in IWM. All right, I'm going to pull this over a little bit, and then we'll talk about the trade that we set up on Friday. And I was a little bit saddened on Friday because the trade ideally should have been put on Thursday in my mind. As a matter of fact, that's when I did it in my account. So one day later, we had the marketplace hanging around here on Thursday, right? And then on Friday, the market had a fairly strong move to the downside. If you look at the highs and lows on this candle right here, that was Friday. And now we are in this channel. And if you just see how many times the 200-day seems to add a little bit of support to the Russell 2000 index, you do see that here and here. And by the way, we are talking about the IWM, which is the underlying that we're trading in, but it is the ETF that tracks the Russell 2000 index. And it does a pretty good job of it. And now if we close below on this candle, down around the 214 level, I almost would switch my forecast in IWM, and that I would want to get more bearish on the actual index to the downside. So we have a long straddle on, which means to start with, we are long. Well, to start with, on Friday, we got long a call, we got long a put at the current market price, the most at the money option contracts. The put will be worth more than the call at this point in time. It's still not a huge move to the downside. Now, if you started when we first started talking about it, we were up right around here, around the 225 level. I personally put it on in my account right around the 221 level, and now it's down to the 214 level. Paid around $11 for the long straddle, and because we put it on, I don't know, I guess noon was right around this. I can look at the screenshot, but we're right around this level. It's down a little bit. Now, one of the things that I didn't like about putting it on Friday is that it was a down day and implied volatility had jumped up a little bit on it. One of the things that enticed me with the IWM straddle is that it was on the lower end of the range as far as volatility is concerned. The IV ranking, if you have access to stuff like that, was right around the 20 handle, which implies that it's in the lower end of the range. The higher the IV ranking, the more, I guess, juice there is relative to where it's been historically. So now it's back up a little bit, and let's go and look at that. And we'll talk. I don't want to talk too much above and beyond. Let's go IWM. Well, here, let me start in the what if calculator, and let's just pull this long straddle on over into the trade ticket. All right, so here we are, IWM trading. Of course, IWM. I didn't finish my taping. IWM, February, going out. We got a lot of time. That's one thing that's nice about the IWM here, is that time premium isn't that outrageous considering the volatility. I've always thought that IWM options in general trade a decent implied volatility relative to the actual volatility of the IWM. But here we're showing it at a 25% level. The historical is around 23. When I started looking at the trade, the IV was around 21. Now it's at 25 because we've had a down move. Historical vol is always historical vol. That's the actual volatility of the IWM. And we see it trading here at 217. This is the strike that we chose. Market is now at 215. It's down almost, well, it was down almost 1%. Now it's a little bit less than that, down $1.80, trading at the 215 level. And this is the expiration. This is that expiration. All right. And right now it's at $11.23. And we actually paid up a little bit more than that for it. We paid $11.80 for that trade. But I don't mind where the trade is at. Put and call. I'm kind of surprised that it would be down 60 cents on the trade. The implied volatility when we purchased this trade was trading at around 25%, and it's still there. So vol hasn't really moved much on this, but yet the trade is down. Now, 37 days, and we're down 60 cents on the trade. I wouldn't expect to be down that much. All right, but I like where the chart is at, in that we're sitting right here on this precipice of the 200-day moving average, and it does provide some support. So you saw a strong breakthrough here in the 200-day moving average, and it took a while before it came all the way back down, came down, almost touched it here, touched it there, almost touched it there. So a break down below the 200-day moving average, it can be a bearish move in the IWM at this point in time. And that would mean that we could come back down to, I actually filled this little gap down around the 209 level, and then obviously come all the way back down to this trading range where that next stopping point may be, which was right around 197. We have about 32 days remaining until that expiration date. Actually, I had 25 days remaining. February 14th is the 32-day one. So we got 25 days remaining until that expiration, and we have a lot of news that's going to start coming out. And then also, when we get into January, we have earnings that will be hitting the marketplace. So I do think the timing was right to do a long straddle in IWM, and we'll let this trade play out. All right. If you have any questions about the trade, I am surprised to see that it's down 80 cents, though. But the market is what the market is. The market is pricing at that. If you have any questions, please do put them in the chat box. I'm happy to try to address this trade. We have a lot of time. Like to see it break down below that 200-day moving average. I have no problem selling the put option and then just remaining long the call option. IWM definitely has that potential to make you profitable on both sides of the trade. Just from you can see just from the chart, from the movement, from the range that it can go in. So I'm just going to keep a close eye on it, and we'll let this ride into the 20th and into the inauguration. That's not that far away. Okay. SPX. So I've done a few trades, and I've been a little bit befuddled by the markets. You see some signs of light. You see some signs of the market wanting to bounce back, and then it makes a strong reversal. And I feel like every rally gets sold. So we looked at recently, we've done a long call spread on a Monday. We've looked at a put butterfly spread, a bearish put spread in the SPX. And I kind of came to the determination this morning that the trade that I want to work through is going to be a skip strike butterfly in the SPX. Markets have been really choppy. It's been hard to get the weekly direction correct because, well, first of all, there's just a lot of uncertainty in the marketplace with all the talks of the economy, of the news, of tariffs, of inflation, of where the Fed's going next, bond yields, everything that I talked about at the top of the show. So I think the strategy is a skip strike butterfly. I kind of came to that conclusion this morning. So we're going to look at that trade, and I'm start in the what if calculator, and we're going to go into this butterfly, and we're going to be bullish on the market, or we're going to be, I should say, the skip strike butterfly, as I'd like to talk about it, means that you are selling a short call spread to pay for a butterfly. So you're getting it done for a net credit to the account. It's a trade-off of just getting short a call spread, a bearish call spread, which is neutral to bearish on the marketplace. And I like to take the credit from selling that call spread and actually buy a butterfly. And hence, we are skipping a strike that embeds that credit spread into the butterfly. So it's a easy way to think about the trade. And this is a trade that, to start with, would like the market to go down. But at the end of the trade, it's okay if it goes back up. And I say that by, if you look at the green line here, this is the profit and loss on the strategy as of today. So as the market climbs towards our strike, the value of the butterfly actually goes against you. But then as expiration approaches, which would be towards the end of the week, it has to morph into the actual profit and loss graph at expiration. So let's send this trade to the trade ticket, and we'll go through it on the options grid. Well, we'll go through it on the options grid and talk about the risks and rewards and the margin requirement that's involved with it. And I'm actually going to pull up the profit and loss calculator, and we'll go through what I mentioned, that we're selling a spread to help pay for a butterfly. And the butterfly is our hedge. So the market right now is at 58.92. The VIX is up, which does help a little bit with any butterfly. You'd like the VIX to be high, and if you're correct on your forecast, you'd like the volatility to come back in or go down in the VIX. And we got the VIX trading right now at the 20 level. So we're going to go out fairly far in time. We're going to do the January 29th expiration. And January 7th. What am I talking about? January 17th expiration. That's why those strikes aren't there. There they are. We're going to do the January 17th expiration. We're going to buy the 59.50 strike. We're going to sell now. More importantly, we're looking at about the delta here is now at 8. It was closer to 10 when I first put on the trade. It's still trading at 55 cents, so I don't mind that. We're going to buy that 55.90. Low probability of it finishing above that strike because we're actually doing we're taking this trade on as an alternative to a short call spread. Okay, so you want the net credit to be a high likelihood that you're going to receive it. And if the market comes back and it lands within the strikes, well, then you get a bonus, but that's not the goal of the trade. You want the markets to stay where they're at or go lower. And I kind of feel that we might just hang around this 5,800 level in the S&P 500 index. So we're at 59.50 right here. Then we're going to sell 2 of the 59.60s. We literally skip the 59.70 and we buy the 59.80. Right now, the net credit at 50 cents. Got it. That's where I want. Keep it right there. Send that in there. You usually can get decent fills, especially if you're bringing a 3-legged trade down into the S&P 500 index option trading pit. If you do that, you can usually fill fairly close to the midpoint. So I would let this one work for a little bit at a net credit of 50 cents to the account. But by skipping the strike, you're embedding a short spread into the trade. So I'm going to, let's remove this. And I want to show you, if you just did the short spread, right? First of all, we'll use that to talk about the requirement. But we're going to sell the 59.70 and buy the 59.80. Okay. Now that's saying that that's trading for a 50-cent net credit to the account. You would have, so the market's moving on me a little bit, but if you do this trade, you have a 10-point requirement. That means $1,000 for every 1-by-1 spread that you do. And you're going to bring in a net credit of 50 cents to the account. So for the maximum that you can make, which is 50 cents, your maximum upside that you can make on this trade is that 50 cents. And the maximum risk is going to be $9.50. You're going to have a margin requirement in your account. This is one way that you would do a neutral to bearish trade. This is called a short call spread, or a call credit spread, or a bearish call spread, if you'd like. And that's where we're at. Now, the concept here is that you would take this credit and actually pay for the butterfly. So let's go and flip this out. I wasn't expecting that to be a 50-cent credit. I thought it would be more. And let's get rid of this leg and go back to where we were. We sold 2 of the 65s and bought 1 of the 50s. All right. So yeah, that's moved now. It's 35-cent net credit to the account. So in hindsight, the butterfly is trading, if it was, call it 35 cents. Okay, let's put it at 35 cents. So the butterfly, if you did a standard butterfly that's only 10 points wide, which that's not very wide in the S&P 500 index to do a butterfly that way, is trading for about 15 cents. So you're selling the short spread for 50 cents. You're paying for the butterfly, which would cost you 15 cents. And right now that net credit is at 35 cents. Now, I would rather move this because the market's moved against it. Like I said, when I was looking at it, the delta was around 10. So the market has moved. So here's how I would adjust the trade since this morning when I looked at it and set this trade up. So my goal would be to get somewhere around that 50-cent credit. And I think that we can get that by moving down to the 10 handle here. Well, let's try this one, 59.30. That's a little bit more than a 1 standard deviation move away. So let's adjust our strikes. And we will buy the 59.30. We will sell 2 of the 59.40s. 1, 2. Skip the 50s and buy the 59.60s. $1,000 requirement on this trade. And obviously, this is the side of the graph, and I sometimes forget to mention that. These are calls and these are puts, and this is the options grid. But if you watch Options Guy TV, you would know that already. And yeah, close, 60 cents, 55 right now. I like that 60. All right, we'll make it 55, and that will be our official paper trade for the week. We're going to have $1,000 requirement because we skipped this strike. We're going to bring in a net credit of 55 cents. And ideally, if we were doing the short call spread, we're literally spending 15 cents of that net credit to have our hedge on the trade. Now I can send this one to the what if. And then I'm going to try to explain this by looking at, let's zoom in, not that way, come on. Zoom in like this. There we go. Market's at 57.90. 59.50 is where our home run would be if we finished at that strike on the expiration date. To start off with, though, the marketplace is it would be going against us. This is more so at closer to the expiration date, but as the market goes this way, the trade will kind of hurt us a little bit until we get closer and closer to expiration. And the way that I like to look at this is this is just my hedge. This allows me to stay in my short credit spread a little bit longer than I would if I was just short that spread. And I like to do this especially on shorter term trades. If I'm just doing a short call spread in the S&P 500 index, I'm probably going to go out 45 days because I want the premium to protect me and to allow me to adjust the trade. We've already done the adjustment in this trade. So we've already started with our hedge. Our whole goal was to sell a short spread and bring in a net credit. And that net credit would be about 15 cents more than this. And that has a lot to do with the fact that the VIX is actually trading around that 20% level. That implied volatilities are higher. But with that said, that's how we are going to approach this trade. Now, let's back out. Let's pull back out a little bit here. And I'm going to I'm going to switch screens. And I like to show this by doing by using my website, optionsplaybook.com. And let me pull up one more thing here before I get there. Need a butterfly with calls. Okay, so let's go to Options Playbook. And here's the trade. And this is what I was showing you with the what if calculator with the live markets in the S&P 500 index. What I was comparing it to, so strike C to strike D. That's the one that we're skipping. If we sold that short spread, this is what the profit and loss calculator would look like. It would look just like this, right? You have small upside, and you have more downside than upside, but you have a high probability of success. And in our instance, we were looking at a 10-point wide trade that had a 50-cent net credit to the account. We adjusted it. The market would have been a little bit different. We moved the trade down a little bit. But if we sold that short spread, and this is what a standard butterfly looks like. You have limited and known downside, limited and known downside here. If the market goes down, you have limited and known. If the market goes up, you have limited and known. You can hit a home run right at the middle strike, but that has to close right at that strike B, right at expiration. So all that is you sell this to pay for that, and you end up with this. And ultimately, by doing that, you're really just skipping strike C. So a good way to say that too is that strike C here, you're really just buying and selling it, if you want to think of it that way. And that we are skipping it. We're not going to do that process. But if you put on this long call butterfly and you had it in your account, and then all of a sudden you're like, okay, I want to sell a short spread, and you sold in that short spread strike C and bought strike D, which is what goes here, that would be one way to think of it, that I bought the butterfly and then I sold the short call spread. So I like to say it as many ways as possible, but ideally, why go through that hassle, right? Why not just skip that strike? That effectively puts in a buy and a sell of that C strike. And here's our situation. We have a 55-cent net credit here. We add additional risk from strike C to strike D. But if you go back to the chains too, you're quite a ways away. We're putting this trade on with a 10 delta, 10% chance of that underlying finish 1 cent in the money on expiration above strike A. So very low probability of it getting there. We go all the way out to here to where our risk kicks in as expiration approaches. Now we have even a lower probability of it finishing there. Now, the market starts moving, this thing will lose value as the market goes up. Basically, we're starting on a Monday. We go Tuesday, Wednesday. If the market has moved up, our spread will, our butterfly, our skip strike butterfly, will cost us more to close it. We'll be losing money on the trade, just like if we did the short call spread. So try to keep that concept in mind, that if we did a short call spread and the market moved against us, that we would be losing on that trade. Now, also in the short call spread, if it gets to Thursday and it's only moved half the way, let's say half the way to the strike in our short spread, well, now we're probably up on the trade, right? Because time decay is winning the battle against delta. You're getting theta, and delta isn't moving your option contracts hard enough against you. So just like in a short spread, if it gets half the way, but it takes more than half the time, you're probably okay on that trade. You're probably up on it. And that's the way with the skip strike butterfly. Now, here's the upside of it, though, is that if you get to Thursday and the market is trading close to the strike, well, now you might even be able to get more profitable if it lands somewhere between strike A and strike C. You can actually put this trade on for a net credit to the account and then take it off, unwind it, sell it, if you will, or a better way to say it would be close it for a net credit. So you put it on for a net credit and you take it off for a net credit. So that's the way it would work. But ideally, if I'm putting the trade on, and let's back out, we'll go back over to the Trade Hawk software, or Trade Pro. I keep saying Trade Hawk. Trade Pro. Okay, here we go. So if we do that and the marketplace does start drifting higher, this is what it's going to start looking like at expiration. This is our profit and loss graph as expiration is approaching here. So you have a decent scenario in the end, but ideally you put it on, market hangs around here, and your goal is going to try to make that 55-cent net credit to the account. All right, a little bit, exactly 30 minutes. So as promised, you have any questions, I'm going to give you one last chance to put them in the chat box. But I've struggled, well, the marketplace has struggled, and that makes it a little bit, the market's been hard to trade on a weekly basis. After the elections, we did really well with our SPX trades that we were looking at, and other trades. Not to mention Goldman Sachs trade. I meant to bring that up. We'll talk about that one on Wednesday. But we're heading into earnings season. There's the January is going to be a real interesting month. It usually is. And going into the end of January, there's going to be a lot of things that are going to happen in the marketplace. I think it will be interesting and fun to trade the marketplace. And let's hope. I think this is the trade. I think this is the strategy that I want to lean on, especially this week and maybe a little bit more going in as we get into the earnings season. Might want to do a few more of these SPX skip strike butterflies on a weekly basis. Thanks for stopping in. We'll see you this Wednesday inside hub.tradier.com. If you'd like to check us out there, or go to x.com, check it out at my profile, which is at Brian Overby. Also at the Tradier profile, which is at Tradier. And those are 3 different locations that you can find Options Guy TV. Please share with all your friends, family across the board. We want to make this as interactive of a show as possible. See you this Wednesday at 11 a.m. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.